All right, folks, welcome back to another episode of the Property Couch podcast. And today's episode is a beauty. You are not going to want to miss this one. There is so much in it for every single person today. Ben, what are we going to talk about?
Mate, tricks of the trade when it comes to mortgages and dealing with the banks and beating them at their own game.
How to put more money back in your pocket and less money in the banks, folks. Stick around. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, mate, welcome back to the Property Couch. How are you this week?
Oh, nervous. Finals footy. We should all be both
You should be nervous, mate. You should be nervous. No, I'm more nervous than you. I'm out this week if we lose and it's raining. And if you look over through the history, you'll see that we haven't done so good when it's wet. But anyway, fingers, toes crossed. But let's get on to all things for this episode. It is a big show. We've got a lot to get through. Let's see how many times we can overtalk each other. That's brilliant. So the first one is the Pippa Sentiment Survey, Ben.
Yeah.
Hopefully, heaps of our listeners filled in the Pippa Sentiment Survey. So that closed off yesterday. And I think there'll be some wonderful insights which we will cover to a later date. But fingers crossed that there quite a few people got amongst that, Ben. I did. I feel
property's in the news everywhere, Bryce. So I've got heaps to say in what's making property. It is a massive show today. It really is.
I think if we talk about, folks, this is how I'm going to set this up for you. If we talk about the Property Couch being the insider's guide to property finance and money management, today is going to give you the insider's guide to finance. I promise you, stick around to the very end. Because you may be leaving money on the table. We're going to make sure that you're not. But hey, last week's episode, Ben, we got to number 2 in the charts, which I'm super grateful after all these years that our community still supports and listens to us. I want to read out something. It is a review that we recently got on the Property Couch. Yes, I read each and every one of them, including the ones where you give us negative feedback. But this one, thankfully, is positive feedback, Ben. And this is from El Brizzle My Nizzle. And it says, a wealth of useful information. This podcast has been the most informative and useful audio resource relating to property I've come across today. I've listened to a good 90% of the episodes, and quite simply, I feel pretty grateful this resource is available to me completely free. It has helped me completely turn my finances around and get myself in a good position to purchase my own home solo. Thanks, team. Keep up the great work. You're definitely changing lives. Now, the reason I wanted to read that out, Ben, is it's incredibly humbling for us to know that the mission is actually succeeding and helping people. But the other thing is I wanted to ask a favour of folks, because we've been super lucky that our audience shares the Property Couch with others and spreads the word through word of mouth. So I'm going to try and encourage everyone to do that. So here's the favour. If you have enjoyed the Property Couch, you can relate to that review where there's been some benefit. If you can share it with 2 friends, that'll be super helpful, because what happens is you tell 2 and they tell 2, so it's 4. They tell 2, it's 8. 2 is 16, 32, 64. So it becomes this exponential organic growth of getting more people onto the podcast so that they can change their life for the better, Ben. So what I want to do is, if you've got this episode, I promise you this episode is going to help you and it's going to help other people. So if you take a screenshot, if you're listening to it on your phone, take a screenshot of your phone and then go and post it in your favorite social outlet. Ben, you love Twitter, so you'd put it in Twitter. I'm often on Instagram, so I put it on Instagram. But wherever you are, LinkedIn, Facebook, just take a screenshot, tag 2 friends, tell them they need to listen to it. And also tag us at the Property Couch so that we can get back to you and say thanks for the shout out. So, okay, special favour, folks. So if you get an opportunity to do that, we would be forever grateful so that we can spread the word about the Property Couch to more and more people. Hey, my Mindset Minute theme today, Ben, is from George Soros, who is a Hungarian-born American businessman and philanthropist worth several billion, lots of money, worth listening to, gives a lot of it away, right? But he has said this: whenever there is a conflict between universal principle and self-interest is likely to prevail. Now, I'm going to leave it at that. We're going to do the episode, and then I'm going to circle back to it in the life hack, and so you'll see why I've thought that is a poignant topic for us to just sort of meditate on. But whenever there is a conflict between universal principle and self-interest is likely to prevail. That'll make more sense as we go through. But big show, Ben. We are talking about, are you leaving money on the table? How to beat the banks at their own game. This is going to be huge. So let's set the scene, mate.
Well, I mean, look, more than ever, with interest rates going up, we want our money to stretch as far as possible. And the best way for our money to stretch as far as possible is to get at the front end of the price bus, making sure that our mortgages that we have got, whether they be for owner-occupied purposes or investment purposes, are competitive. And this is what we're going to be talking about. We're going to be basically lifting up the covers. And from an investment-savvy mortgage broker's point of view, we're going to be talking about some of the elements. So we're going to tell you about the game of property and the game of finance and how all that comes together. And then some of the information that you need to learn how to compete and win. So it's that knowledge, that information, understanding those tricks of the trade, which will allow you to be better equipped in dealing with banks and lenders. So that's why I'm super excited about this episode, Bryce.
Ooh, arm you with the knowledge so you can better understand the tricks of the trade. So here's what's at stake. Your money that you could be giving up if you don't play the mortgage game properly, and potentially thousands, if not tens of thousands of dollars, Ben. That's a big statement. So have you got any examples to back that up?
Well, I'll use a simple one, Bryce, and this is where interest rates are competitive and cheaper. So let me use this example: $500,000 loan. If you're paying 3.52 over a 25-year period, and you pay the minimum repayments, versus having a loan that's say 3.05, so a cheaper interest rate, there's $37,000 on the table just in paying the minimum repayments. So the quicker you pay that off, the greater those savings will be, if you think about the amortization story that we've talked about many times on this podcast. So from my point of view, that is a material number. It's tens of thousands of dollars. And we know that getting retail rates or competitive variable rates around 3% is going to be a thing of the past. So the higher that value goes, so if we see interest rates starting to get into the fives and potentially into the sixes, depending on where the cash rate's going to go, you can effectively double that number in terms of the tens of thousands of dollars that at stake. So for me, that's worth getting out of bed for, or in this particular case, reviewing your mortgage. And we're going to show you how to go about doing that in today's episode.
Now, fun fact, our business, Ben, started as a mortgage broking business. It's now evolved into what it is today, but it started as a mortgage broking business. So we are dealing with hundreds of millions of dollars of lending. So these are lessons learned in the trenches. So they're not theory, they're lessons that have been learned over the journey of being involved in hundreds of millions of dollars of lending.
Well,
so
it's billions, Bryce. So we handle around a billion. Yeah, I know, I understand that, but yeah, when you're dealing in billions in terms of settlements per year, your volumes are quite big, and so we want to take all of that knowledge and pass it on to our community today.
Love it. So, how do the banks make, or the lenders make, money off retail consumers, Ben? There are 4 key areas. So let's talk them through.
Yeah. So this is about the scene setting, right? So ultimately, a bank's job is to return value to shareholders and delight their customers in the process. Now, that's a very, very difficult thing to do, right? You ultimately, you want to try and maximize the profits, but you've got to keep your customers happy. So let's talk about the different ways in which they make their money. So the first way in which they make their money is what's referred to as a net interest margin. Now, the net interest margin is the difference between the money that they earn in lending money to you and me versus the cost of them getting that money, okay, to lend out. So what we're basically saying is that margin usually sits around that 2%. And with competition in the market, that can potentially force that net interest margin down as low as 1.7%. Now, if that net interest margin is going down, The share price usually gets under pressure because the analysts are sort of saying they've got margin pressures. And so that's a big problem for the executives in the bank. They've got to try and keep that net interest margin as high as they possibly can. But through competition, and this is what we're trying to teach our community, is to take action, that is going to come under pressure. Now, the second way, Bryce.
Well, on that, Ben, I think just for our listeners, you need to really land that. That's important, because that net interest margin is going to rear its head throughout what we're about to talk about for the next 30, 40 minutes.
Very much so.
Because if you understand that core basics of how much they charge versus how much it costs them, which is their profit, you'll see some of the ways that you can not leave money on the table and put more money in your back pocket and less in the bank. So number one, net interest margin. Number two, Ben?
Yeah, so it's called loan book growth. So if you can't get margin, or if you're being squeezed on margin in business, the other way in which you can grow profitability is just grow the size of the business. And this is referred to as loan book growth. And so the overall size of the loan book. So you might be getting squeezed on margin, but ultimately, if you're growing the size of the loan book, you might be able to increase productivity and profitability through volume. So I think that's an important one. So they're the two big earners for our banks. And in reality, 60% of the profits usually come through residential lending to our big four banks. So it's a massive part of their business, and they are the two big areas. Number three is around fees and charges. So if you've got a check account or any type of general transactional account, and you don't have a professional package, or you're not paying an annual fee to them, they're the types of ways in which they also pick up some additional revenue. So account keeping fees, international transfers, bank checks, different types of one-off fees that they're charging, or monthly or annual fees that they're charging. And finally, another small portion of that is around cross-sell. So how do they vertically integrate things like selling you into their credit card offerings, or maybe their insurance products, and these days also some of their share trading accounts as well. So they are looking at those are the big four ways in which the banks generate profits from predominantly lending money to obviously mum and dads, individuals, and also businesses.
That fourth one, Ben, is important too. It's part of their strategy to integrate you within the bank, because as soon as they cross-sell you to other parts of the business, it makes it very, very difficult. If you think like the octopus that's entangled, very difficult for you at the very least to mentally unwind from leaving that particular lender. That's part of their strategy, and that's what they want. And that one, third one, Ben, fees and charges. Surely they couldn't make much money on fees and charges. Surely that's pretty reasonable fees and charges that they
not as much as they used to. Not as much as they used to. That area of revenue has dropped considerably over time. But coming back to your point about, yes, their numbers tell us that the stickiness, the more products you have with them, the tentacles Bryce was talking, that makes you more stickier and less likely to move to another lender. And we all know that is part of the challenge of getting a mortgage review or looking at moving banks. You've got all your direct debits, and you've got all of these other pieces that you've got to do this administrative homework. But we've just talked about potentially $30,000 to $40,000 on the table as a minimum return in terms of keeping sharpening the pencil on your interest rate. So it's really important to say, if money's not that important to you, and if you want to leave that money on the table, that's completely fine. But our job here and our passion is about making sure your money's working hard for you. And that's all about what we're going to be talking about in terms of how do we compete and win in the bank space.
Get more money for you. Now, I'll tell you a story, Ben. Back in 2004, I think it was, if my memory serves correctly, had a friend who was a business banker for one of the big fours. I won't say who it was. I was living on the Gold Coast. He was living in Coffs Harbour, helped me with some lending. He taught me about this word entanglement. And I said, what's entanglement? He goes, on Monday mornings, we talk about entanglement. I said, well, tell me, what does that mean? He goes, how do we get the customer to be more sticky through what we just talked about? And that octopus analogy is very, very poignant for that. So it happens, folks. It's real. It's happening every day.
And it's legitimate. I mean, that's their job. They're a bank. Their job is to make themselves stable financially and return profits to shareholders. So we shouldn't be thinking of them as the enemy, but we absolutely should be sort of saying, well, if you want my business, right, and there's competition out there, you've got to work hard for my piece of business, right? I am not going to give you extra fat on the bone because of being lazy or using inertia. So this is, again, why we're here today and why we want to talk about this particular topic.
First point we want to talk about, Ben, is lenders go on sale. So the big question is why. We talked around the edges of this. They want to grow their mortgage books, and it's largely an attempt to grow profitability, because there is that tension between the best outcome for the customer and the best outcome for the shareholder. And for the banks that have a daily share price scorecard, it's very important that they do drive short-term results around profitability that come from making sure that they grow their books. So the lenders do go on sale and they make offers to get you in. They'll give you cashbacks, they'll give you loyalty rewards. And of course, the one that's most interesting to everyone right now is around sharper interest rate pricing. So they go on sale, Ben, which is interesting for a lot of people to think about, because quite often they get it done up front, and then they go into a pattern of, let's get on with life. I've got the mortgage. I'll do whatever it takes to pay it off as quickly as we can, but don't necessarily think about the product that we've got and whether it's longevity. But they do go on sale, don't they?
Yeah, like it's an enormous industry. I think 2.1 trillion, if my recall is correct. So yeah, and ultimately what you've got to think about mortgages is that they are potentially evergreen. Like, a lot of people think that you've got to stay in a mortgage for the term of the mortgage, the contract. No, you can rewrite a contract with another lender, which will discharge that mortgage against that property, and you'll take on that new loan. So start to think about mortgages as a commodity. Okay, start to think about it as something that can go on sale and will go on sale. And if I'm sitting there as the head of one of the big banks, or even one of the competitors, the mid-tier banks, and I'm 25% off my budgets in terms of the amount of loans that I needed to settle, I'm going to do whatever I can to go on sale. So I will sacrifice net interest margin to compete in that space to win volume. Because if I'm losing volume and I'm not competitive, I need to play around with price. And what we're seeing out there at the moment is a lot of lenders are offering, $4,000 cashbacks to entice you to come across. Some of them are offering, loyalty points, Qantas loyalty points, or whatever, frequent flyer points, those types. So that is what's happening in a marketplace. And if you're thinking about the marketplace in general, there's not a dozen lenders. In our particular case, I think from last recall, I think there's about 45 lenders on our panel. Now that gives us, by way of example, over 1,000 different loan choices that are available for us to dissect and interrogate and try and work out what are the best opportunities for that. So most brokers, most investment savvy brokers will have at least 20 different lenders on their panel, and that gives them a chance to shop around your business. And as I said, if they're going on sale, it's really important to note that the timing of that sale and when you're looking to do that review is going to be important.
So the key takeaways to this point about lenders going on sale is this. You may think you're on a good deal, but this is happening all the time in the background. And if you're not aware of it, you're missing an opportunity. So from time to time, as Ben pointed out, then they have that tension between, I've mentioned this before, Ben, I'll mention it probably a million times going forward. There's economics is largely the study of human incentives. So if you just talk to an incentive there when someone was just under budget for what they need to get for their loan size for that particular month, and they'll do what it takes to fill the gap, because they'll probably have their own income incentive based on hitting those targets. And then at the broader level, it helps them, the business hits the goals, which at the broader level helps the shareholders hit their goals. So it's important to not be ignorant to the fact that this is going on. This is happening all the time, folks, and you need to get amongst it.
Yeah, and as competition gets tougher, and potentially this year we're going to see less purchasing transactions that we've seen. We saw record purchasing transactions last year. So that's why competition is tough. We know that there is over $30 to $40 billion worth of fixed rate loans that are going to be coming out of their term. And so that's why it's a really competitive space, and it's dynamic. It's changing week to week. Whereas maybe in the past, it might have changed month to month. We're really starting to see a lot of ramp up in terms of the sales that are coming through and the pricing by the lenders to try and win new business.
There you go, folks. Lenders go on sale. The next point we're going to talk about is published rates are negotiable. So what banks and lenders show on their website should just be the starting point. And Ben, if you're a highly prized client, there's more on offer. So let's talk to that point.
Yeah, so again, coming back to the banks are trying to attract high quality lenders, right? So borrowers, I should say. And those borrowers, what they're looking for is really stable employment. They want to form a relationship with you, not just for a couple of years, but hopefully over the next 5 to 10 to 15 years. Their loans are significantly more profitable if you stay as a customer beyond that sort of 3 to 5 year period. So anything beyond that, there's a real solid margin that they start making on those loans that they send out. Again, that's their job. Our job is to obviously interrogate that and try and find those deals. But highly prized, what does a highly prized client look like? They are usually people with above average incomes, and again, are about to either purchase that property or renovate their home and continually keep borrowing money. And also, because of that higher income coming in, remember deposits are the cheapest form of money that they get. And so they make a good margin on the deposits that they receive. So ultimately, they're lending that money out as part of their strategy. So the more that they can attract more money coming in and more savings and more deposit money, they can then lend that out, and obviously to how they make their profitability. So that is what they're looking for. And again, coming back to that cross-selling in terms of being able to make you stickier as part of that. Now, the final message here around published rates as well is that they are what we call sort of the rate sheet. So they have their rate sheet that they have on their websites, and aggregation of loan size does matter. So if we're now putting our investors hats on here and we've got clients, or you're a person in the community who has over $1 million in borrowings, but you've got that separated between 2 or 3 different lenders, this is an interesting time to price up the aggregation, because when you aggregate your lending, so total lending size, that is ultimately where you're going to see the banks try and win your business, because what we talked about before, loan size matters. So when loan size matters, they do price for people who have bigger loan sizes.
And it's an insider's game too, Ben, because if you're on the inside, you do know this, you get the relationships with the people that allow you to go, well, what if I do this? And here's a strategy, and bring it across, and they get excited by that because it'll hit some of the targets that we were talking about before. But so folks, here's the key takeaways from this. 1, everything is negotiable. So that's to be remembered. Number 2, this is important, and we want this one to land. If you don't ask, you don't get. So it's important to be the squeaky hinge that's getting the oil here. One of our team told me a story yesterday where they were looking to ask the question on their lender and were surprised about what rates that they could negotiate. So it's important to be of that fundamental principle. If you don't ask, you don't get. So that's important.
Yeah, and I think when you are on the insider's view, Bryce, what you were talking about before there is, we get those emails from the business development managers, the BDMs of the bank, saying, we've got special pricing at the moment, ask us about our pricing, right? So again, they're not necessarily publishing that to the broader market, and that's a sensible thing that they need to do. I mean, ultimately, if they published everything, their net margins will drop considerably, and when they do, that is all their profitability that they'll be wiping out. So they need to do this in a very sensitive way, and maybe a backdoor way, you might say, in terms of how they buy business. Now, also remembering that the broker market now controls 70%. So basically 2 out of 3 loans are now written by brokers. Now, if that's telling you something, it's basically telling you that consumers have told you that a broker adds more value to the conversation. They give me choice, and so I'm going to use a broker to do the shopping for me. So that is also an important point. So that's why the lenders come to us as brokers and say, hey, we need to top up or grow our loan book size. We need to get more loans in the system. Of course, I need to put a caveat on here for any regulators listening. It's all responsible lending. There's still credit policy that they need to follow. Everything's still vetted the right way. Some loans will be declined or declined because they're not suitable or they don't pass credit policy. But that still doesn't mean if you've got coming back to their quality borrower, that highly prized client, then ultimately that's what they're trying to attract. And certain banks have, these personas of the typical types of clients that they want. So if you're bringing lots of those clients to them, the pricing that they're able to give you. And if you're doing that in volume, also the pricing is very attractive for those businesses who give volume to those particular lenders.
That's just an example. If you weren't under the illusion that property investing is an insider's game, that just actually shows you. Because on the real estate side, Ben, it's 100% an insider's game. Like the fact that when we're playing the buying game, we just get access to deals, information, strategies, everything as a buyer's agent gets in advance of the general public. So it's definitely an insider's game. And then we've talked for 7 years about how property investing is a game of finance more than it's a game of bricks and mortar. So if you can get on the insider's game on the finance game, you can see that you get access to some of those pricing things. But folks, all published rates are negotiable.
Yep.
Everything is negotiable. If you
don't accept the published rate. Please don't accept the published rate on the website. You've got better deals. You can get better interest rates by negotiating.
Next point, Ben, discount rates can be misleading. This is a good one to unpack.
Yeah, this one is starting to emerge, Bryce, in terms of the lots of different changes of happening with interest rates. So I have a quick backstory on this one. So back in the day when I first started mortgage broking in 2004, yes, that's how old I am, life was pretty simple. We talked about this before. Brokers came into the market, Aussie John and other lenders came into the market, and that really meant that you saw effectively the consistent interest rate, and you were getting the same rate whether you were principal and interest or interest only, whether you were borrowing for investment purposes or owner-occupier purposes. It was pretty easy. There wasn't that many rates available. Now, loan to value ratio and some of the second and third tier lenders, yes, they did look at that. Well, the world has dramatically changed, right? Since APRA is taking more of a driving force in this conversation, we now have multiple rate cards. We now have multiple different published rates. And what some lenders are doing is, because the market's getting more educated, they're moving towards more information and more knowledge, is they can still play tricks. They can still play tricks. And how they do this is through discount rates. So these days you might go to a dinner party or a barbecue, and the conversation about mortgages come up, and someone at the party says, yeah, I've got a 2.2% discount off my lender. And someone says, well, that's amazing, and they turn to themselves and say, well, my lender's only given me a 1.5% discount. Now you'd be thinking, okay, well, does that mean that the 2.2 is better than the 1.5?
Yeah.
Here is the message.
What's the reference?
Yeah, the reference is really critical. So use an example. If Bank A has a 4.95% standard variable rate, and I got a discount off that standard variable rate of 1.5, then ultimately the rate that I'm paying is 3.45. Now, what about that person at the barbecue who was bragging about their 2.2% discount? Well, what if their standard variable rate is 5.95? So in theory, once they subtract their 2.2% discount, they're still paying 3.75. So there's still a difference of 30 basis points between the two. So the person who had the smallest discount rate still got the cheapest lending from an interest rate point of view. So this is how they potentially can manipulate the market. So some lenders have really, really high standard variable rates, which is what we refer to as their rack rates. And then they discount off that. But if the rack rate is never really sold, it's really coming down to the discount. So don't just think discount, think the actual final rate that you'll be paying is the key message here. And that's when you really start to compare the pair around, or the options available, to see ultimately what that final discount rate figure is.
So folks, the key takeaways here are discount figures aren't relative, because they're relative to what? So it's really coming down to the final rate that you pay, which is the key, which Ben just went through that example. But it is important to make sure that you don't get into a comparison game about the wrong thing. The comparison game is the end bottom line, what you're paying, which leads into our next point, Ben, which is around comparison rates and the problem with them, because there are some intricacies around how it's calculated and at what rate. So let's dive into that.
Yeah, sure. So just for everyone's benefit, whenever there's a published rate, there also needs to be a published comparison rate. Now, there's been a lot of debate over the last 20 or so years about the benefits of comparison rates. So originally they were introduced because lenders in their, as part of their competition, and they're trying to win your business, they were potentially promoting cheaper interest rates, but with all of the additional fees and charges, the interest rates weren't a true reflection of ultimately the interest rate that you're paying. So hence introduce a comparison rate. And so a part of me says, I like the idea and the concept of a comparison rate, but here's where the challenge falls away. The problem with the comparison rates is that they don't take into account all the fees and charges and all the costs. And they use a calculation of $150,000 over a 25-year period. Now, I don't know.
It's standardization, but no one does 150, and usually they move a fair bit. So it's not really helpful, is it?
No, it's over a 25-year period. 150. I mean, most lending these days is around $500,000, right? So from that point of view, it's not doing all the right things. So just so you know, in terms of comparison rate formula that is used is this. It's an estimate of the interest rate and the other ongoing fees and charges, but not all of them. And they're added up against using the baseline of 150 over 25 years. Now, we've already taught you that when you go up to aggregate borrowings or higher ceilings of lending, that comparison rate is completely null and void because you're getting better discounted rates from the published rate on the website anyway. So that's where it becomes really, really problematic. Now, I'm going to step out on a limb here in terms of, because ultimately, as a licensed mortgage broker, I've got obligations in regards to compliance, laws, in terms of responsible lending and so forth. But what I teach my clients, and when we're talking to our clients, we've got to start talking about the life of the loan, okay? Now, when we're talking about 25-year term or 30-year term, potentially it could be that long. And potentially it's important that you are informed as a borrower to know the true cost of that loan over that time period. But what we do as investment savvy brokers is we're trying to teach the mindset of the borrower to say, we're going to have this loan probably for about 3 years, unless something changes. And we're definitely going to shop this business inside that 3-year period. And we're going to be doing reviews on a regular basis anyway, right? Because ultimately, the value of a broker is to shop that business and try and save you as much as they possibly can, in addition to what we say investment savvy broking, which is about strategy, structure, borrowing power, all those other elements. And that's what you get when you're an investment savvy broker. So by going out on a limb, I'm going to just teach you how you can do a back of envelope calculation.
Here we go.
To work out your true cost of borrowings, right? So I call this the true cost calculator. And it's a very simple way in which you can do that. Now, it's an audio, so I don't have video to explain it, but I'm going to give you the variables that you need to do this calculation. The first one is your loan balance. Okay, so what is the current balance of your loan? The second one is the interest rate that you're paying, not the comparison rate, but the interest rate that you're paying. Then what you need to do is you need to calculate any upfront charges, so the one-off costs that you originally had, and then any ongoing fees or charges over a period of time. Now, what I'm saying to you is don't do that over a 25-year period or the term of the loan. What I'd be encouraging you to do is to do that over, say, a 3 or a 5-year period. And then finally, the other costs that we have are what's called exit fees. So discharge fees of getting that mortgage. Now the government's banned exit costs. So there used to be also these big balloon payments if you got out of the loan early. They're banned, but there are still discharge and release fees as part of that. So here's the calculation. Here's the formula. You take the loan amount and you times it by the existing interest rate. That's the first part of the calculation. You then add the sum of the fees and charges. So those one-off fees plus the ongoing fees over a time period. So you add those two together, and then you sum that with the loan balance and the interest rate. So that's and then you divide that by the loan balance. And that will give you the true interest rate that you'll be paying, factoring in all costs. So if you've got a professional package with say a $300 annual fee, but you had also maybe $250 in settlement fees. So there's a one-off settlement cost and valuation cost maybe for some lenders. So let's say it's $250 is one cost, but then you've got the $300, you times the $300, which is the annual fee over a 5-year period. So you times it out, which is $1,500. You add those two figures together. So you're up at $1,700. Then you obviously have the loan balance times by the interest rate, and you divide that by the interest rate. So you add those things together. Really simple in terms of, I probably didn't explain it that simply, but if you listen back on that, you'll be able to work out what the true cost calculation is.
Well, here's the deal. You rewind and have another listen, or you go and make sure that you're part of our community, Ben, because we'll put this in the communication we have. We'll put that actual formula in so that you can check that out. But the important takeaway here, folks, is having an understanding comparison rate is 150,000 over 25 years. So that's kind of not relevant to what we're doing. So if you use the calculation that Ben says, it's actually shrinking the total costs over a smaller period of time, which is more likely to be the length of time that you'll be using that lending. Because if you're buying your home and you're trying to pay it off over a long period of time and you're not looking to play the finance game, you may have the same loan for a long period of time. But if you're in this space that we're trying to teach people, is where you're constantly reassessing, you're constantly pivoting, you're constantly reviewing, part of this will be turning over loans, and that's just what you do. So some of it will be having multiple lenders at certain periods of time. And at other times, you may be able to take advantage of what Ben said earlier about aggregating and bringing it over, but you're always looking to win in the finance game, which is really important. So if you have it over that smaller period of time, that's important. So as I said, rewind, have another listen to the formula, or if you're part of our email community, which you can just go to thepropertycouch.com.au and give us your details on the homepage there, you will see that in what we send you later on today, actually, comes out later on Thursday, so you get it straight away.
So before we move on and do a summary of what's been happening, here's my disclaimer. With lenders, when interest rates change, or lenders still have the luxury of changing their variable rates anytime they want to. They can't change the fixed rate on you, but they can change the variable rate. So the disclaimer here, even though that's the true cost with the information that we have today.
Yeah, at a point in time.
At a point in time. So let's say the RBA does increase the cash rate by another 25 basis points or 50 basis points, and one lender increases theirs by 60 basis points, that's when obviously that calculation can only be used as a guide only. So that it's always in play. Your mortgage is always live with your lender, and so you need to understand that. So what you're using is the best information of the day, but you also need to understand that it is subject to change. And that's an important message in terms of the risk and understanding. So again, the irony here is you can potentially get one of the best products in the market today, but next week or 2 months later, there are better offers in the market. We can't guarantee that, and we can't guarantee what the banks will do in terms of passing on any of the cash rate changes that are happening from the lender. I can be pretty confident. I will say this though, Bryce, I'll go on record and say that I believe that the majority of the banks during this tightening cycle will not raise the rate higher than the cash rate change by the RBA. But here's my kicker. I can almost be 100% confident that when the cash rate starts to come back down, once inflation is in play over the next
finance is too much, can't pass it all on.
Guess what? They will. That's when they will start to get back their net interest margin back into shape. Okay, so they realize that net interest margin is going to take a hit over these next 12 to 24 months, but they will start to regain that margin on the inertia of the borrower who won't move because they're lazy as part of that. So be mindful. I don't think anyone's going to be crazy enough, any bank's going to be crazy enough to go higher, but on the way back down, when the cash rate will hopefully land around 2.5% long term, what you're going to see there is that little bit of that margin grab.
So good clarifying point, Ben. It is a snapshot in time. It is what the comparison rate is actually trying to do anyways, comparing a snapshot in time. So your disclaimer is there to say that it doesn't have evergreen status to it. It's just for you to make some decisions around comparing. So, all right, what have we covered so far? We've talked about lenders going on sale. We've talked about published rates being negotiable. We've talked about discount rates can be misleading. We've just talked about comparison rates. Now, you've kind of hinted on this, Ben, but we're going to talk about the loyalty tax. And existing borrowers, generally speaking, don't pay as much attention to interest rates as people who are in the market trying to shop, doing it now because it's out of sight, out of mind. Whereas the new borrowers, they are comparing the market. It's kind of, if I use the real estate analogy, it's a bit like the real estate agent who has a whole breadth of properties, maybe at 2 million, right down to the $600,000 apartment, everything in between. Whereas the buyer is super hyper focused on one particular price point. It's the same for the borrower who is currently looking now. They don't have that hyper attention. They do have the hyper attention that the existing borrowers don't have. But loyalty tax, that's an interesting spin on what you as a borrower will experience if you do the inertia and the inactivity and, in some cases, laziness that you just spoke of.
Yeah, I think what we need to understand is when there's active competition, the banks need to meet the market. Now, if there's competition there, they will have to adjust their pricing down. Now, if there's less competition, they can push margins higher. And what you'll find over the journey, over time, is that those borrowers who got loans 2, 3, 4, 5, or 6 years ago got them when margins were a little bit wider, when there wasn't as much necessarily competition. So ultimately, as money gets cheaper for the banks to access and then on sell to us, that ultimately means some of those second and third tier lenders can come into the market and compete against the big boys like CBA, NAB, and those types of guys, because they've got money cheaper, because the cheapest form of money usually comes through CBA because they've got the biggest deposit holdings. So this is where that laziness over time comes in. So the more competition on margin for current borrowers, it results in new borrowers get better deals than existing customers. So we refer to that as a loyalty tax. So if you want to be paying a loyalty tax to your bank, go right ahead. I mean, ultimately, if you want to make those shareholders of that lending institution more profitable.
I was about to say, if you've got bank shares in your super, it's probably okay because your super balance might be going up, but for you as an individual household, not so good.
Not so good. So I would be saying to those people, that's leaving money on the table. Right? We are passionate about making sure you're not leaving money on the table. And this is one of the biggest ways in which you can improve your budget, your household budget. If you're worried about cost of living going up, and yes, interest rates are going up, don't give it all to them if you don't have to. This is a perfect reason why, well, wait a minute, should I be, this bank should be loyal to me. And this is probably where I want to make an important point. Mm-hmm. Like, banks have got a tough job, right? Like if I was an executive in a bank, I've got a job to do in terms of, again, keeping satisfied customers, but the balancing act, the tightrope that I need to walk in terms of continuing to deliver profit to the shareholders and retain my job inside that bank. Now, I'm not going to, when was the last time, has your bank ever rang you, Bryce, and said, hey, great job, mate, I'm just going to put your interest rates down because you're just a good bloke, and you've been paying your loan on time. It doesn't happen, all right? So ultimately, what we've got to be in understanding of that, they're not going to tap us on the shoulder and say, here's a better deal for you. The only way you're going to get a better deal is if you ask or you shop around. And so that is understand that that's the nature of the game. Understand it. If all of the banks went to a net interest margin of zero, the whole system breaks down, the whole fabric of the lending system and profitability, the whole thing gone, right? So ultimately there does need to be a margin and they need to keep to remain profitable. And the more margin that they can get through great customer service is but customer service doesn't necessarily correlate in how cheap the money is. And at the end of the day, the lending is just a widget. It's just money. It doesn't matter where it should come from. Ultimately, what you want to be doing is making sure that the pencil is pretty sharp on your deal, unless you want to pay a loyalty tax.
And Ben, it contrasts to airlines, doesn't it? So if you buy an airline seat, the earlier you get in, usually the cheaper, the later you get in, the more expensive. But in the banking system, the earlier you get in doesn't necessarily relate to the cheaper that you're paying because of the way that the way that the business model works. So that's really important.
Well, it's an evergreen versus time sensitive. So this is, again, we mentioned it earlier. The beautiful thing about a mortgage is it can be replaced. It is evergreen. Whereas a plane takes off from Melbourne to go to Sydney and you need to go that weekend, you're time sensitive, that flight leaves, you're not on it. There's a premium that you'll pay the later you book on that. So I want people to start getting into their mindset that as part of their financial health and their well-being, they need to be doing regular checkups on their mortgage. It's the biggest expense they would usually have in the household outside of, high school fees or whatever that looks like, car repayments. So it's really important, that this is low-hanging fruit, and we want to make sure you're not leaving money on the table.
So here, folks, with regards to loyalty tax, here's the key takeaway. You must always review your mortgage every 18 to 24 months to see the best deals in the market. But here's the caveat. Any less than 18 months and your costs of exit and entry may diminish the benefit to a level below your effort and time and cost, right? So the sweet spot is that 18 to 24 months and beyond versus the more regular lending that you've done. Ideally, you've got yourself a good rate early, but also some of the costs involved in changing. So that's the key takeaway. 18 to 24 months plus, you should definitely be having that reviewed. So
yeah, and there's some, here's some inside knowledge that just illustrates what we get to know in terms of, we don't have perfect knowledge either, but we have much more knowledge than most of the general public does. Every time you apply for a loan, you get a record on your credit file. Now, coming back to what I was saying before about the types of ideal customers that banks are looking for, you might have really high income. You might be, what they would consider the ideal customer. But when we do a pricing request to that lender and they say, hey, this borrower has moved 9 times in 6 years, then they're not a client for us, because banks do lose money in that first 12 to 18 month period. In terms of the cost to be able to set that loan up, and they start making that more and more of their profits the longer that loan stays with the bank. So, this is what I was saying before. You might go in for a pricing request to your broker. That bank says, you know what, this is not an ideal customer for us. So even though we're offering 2.25% discounts for these customers, I'm only going to offer a 1.75. Yeah. And so that customer is penalised for the amount of shopping around that they do, because the bank knows that they're not going to stay there for long. And ultimately, so there is a balance. And that's why we're saying, as a general rule of thumb, 18 months to 24 months is when you pick a lender, you're probably going to stay there for that period of time. And there's still no reason why you can't ring them up and say, hey, is my pricing still good? That's the initial thing you should be doing, right? In terms of taking a ring up, which is a perfect segue into what we're about to talk about.
Oh, this is a key insight here. That to your point before, too, Ben, the 5 C's, the character. You want to make sure that you keep your character clean as well when you're lending, which is to the point that you were just raising. All right, so the next point, and this will be some real intel, Ben, and this is something that you and the team get to see. But bank customer service and retention teams, what do they do?
Yeah, so again, we're teaching you what happens from the inside out. And so whenever you are refinancing from one lender to another, there is a discharge form that is going to be sent to the other lender, to your current lender, right? So ultimately, if I go from Bank A to Bank B and I agree with terms with Bank B, Bank B is going to ask Bank A to discharge that mortgage. And that is one of the early indicators in terms of what the retention team and the customer service team will do. Now, banks are getting better and better at this. The other thing that's also very common that you need to do is show 3 months of bank statements to 6 months of bank statements and getting all your supporting documentation when you're completing a new loan. So if you're going onto their website and you've downloaded those bank statements, that is a trigger. And you go, indicator. I can't believe it. How did you know? They know this is data on their platform. So they are getting smarter and smarter at trying to be proactive in retention of your business to stay with them. Again, and so they should. I mean, it's absolutely critical for them, their bank, and the profitability of their shareholders. We keep coming back to that. So don't think, well, that's a bit cheeky. It is not cheeky. This is a game. They are competing in a competitive market and they want to retain you for their profitability. So I have no problems with banks and lenders doing what they do. But our job is to understand the nuances in here. And the nuances are these, that if you do get a reach out from the bank, Bank A, who you're now refinancing away from to Bank B, expect to get a call, expect to get a reach out, and funnily enough, expect them to offer you a cheaper rate.
Wow, where were you for the last 7 years, Bank?
Exactly. So obviously you then have to make a judgment call on terms of whether you're going to stay with the existing lender or whether you're going to go over to lender B. Now, the other important part about this is in terms of what should I do to have a quick win? And you hear this on all of the bank shows and all of the personal finance experts. They tell you, pick up the phone, call your bank and ask for a better deal. And before you do that, they do say, go and do some research on the other websites about the pricing that's being done. Well, remember, there's probably cheaper pricing out there. Now, make no mistake, these people have pricing cards everywhere in front of them on their screens. They know exactly the types of deals that are being done at face value level, but they also know the deals that are being done through the pricing. They've got intelligence people inside the banks trying to work out what the other banks are offering. They've got a whole yield management team. Those yield management teams are making decisions on the types of pricing that they will give. This is big business. We are talking hundreds of billions of dollars of money transfers each year. So they absolutely need to be at the top of their game. Now, again, they're yield managing. So the first time you call them, if you haven't got a discharge form done, they will, the people on the phones, on the call centers will have a pricing that they can go to. And they will be able to say, oh, yeah, we can give you another 30 basis points off that, Mrs. Johnson. How does that feel? Oh, well, thank you. That's good. So you're thinking, and that's going to save you X. And you're thinking, great, my job's done here. But just be mindful that the more sophisticated lenders have a step below that. And the step below that comes about in the discharge form arriving, and it goes to the save team. Beyond the retention team, it goes to the save team.
It goes to the wicket keeper.
Yeah, and they do everything they can to try and retain you. So be mindful that there's going to be a lot of wheeling and dealing going on as part of this, and that's overwhelming for some people, right? They don't want to be associated with, why didn't you offer me that in the first place? Yep. So that should be also in the back of your mind in terms of, I've been here with you for a while, you've charged me a loyalty tax, I've since found that out. You need to understand from the bank's point of view, that's why they make their profits, that blah, blah, blah. We've gone through that before, but this is what's going on. Now, you can get yourself to do that wheeling and dealing, or you can get a broker to do that wheeling and dealing, because they're doing it day in and day out. As part of the work that they do, that you engage them to do to work for you. So it really is a fascinating part of the game. This is when the rubber is really hitting the road, and this is where the best deals are found in terms of being able to get that sort of additional pricing. So it's not easy. There's a lot of work involved in this particular stage. You can be overwhelmed. They can put a bit of pressure on you to stay. You've got to remember what's involved in it for you. They're going to talk about all of the inconvenience it's going to cause for you. So it's tough. Okay. So that's why if you want to go off and do this yourself, good luck. But ultimately, those brokers who are doing this day in and day out, they know the game, they know how it's played, and they're going to be doing everything within their power to make sure you get a great deal. Again, you can't be guaranteed the very best, because like next week, another deal could come out in the marketplace, but you're going to be at the sharp end of the pencil, the sharp end of the pricing bus.
See it as a game. It's curious. We'll have the strategy. They've got one level. Oh, hopefully you stay. And there's a second level just to make sure you slip through. So it's incredible what they're doing. So don't get mad. Just get even, Ben. You just got to make sure that you know that this is the game. This is how it's played. You know, there's a fine line. We've talked about this already. There's a fine line between customer outcomes and shareholder returns. That's just what it is.
And don't whinge to the regulators. No. Don't whinge to the consumer affairs that this is unfair. Look, the reality is this is business, right? They are trying to make money. They're trying to give you the loan that you need, and you're trying to do the best thing. Now, and hopefully a marriage settles in there. And if you don't like it, you can leave, right? So, and that's basically the way in which I always think about this. So this is not government needs to fix this. This is unfair. Regulators need to step in. Please don't be that person. remember, if it is to be, it's up to me, or get your professional people to go in to bat for you.
Or Ben, what about some of the mental jail that people just talk themselves into though? Because I'm comfortable with the way this bank has their net banking set up and I don't really want to change to another one. Well, folks, the interfaces are not that too dissimilar. And if you adopt the Money Smart system, our banking structure is very simple. So it's not like you have like for those people in some of the summer series we've had, Ben, where they've got 19 accounts, I get it, right? So first of all, step number one, simplify it down to the Money Smart system. But so if you have a simple banking structure and you have an investment savvy mortgage broker who's part of that, transitioning over should not be a barrier around, I like the interface with BankX versus Bank B, because I've heard that way more times than we care to. So there you go, folks.
People get overwhelmed, don't they, Bryce? And that's, part and parcel of the challenges that we're trying to solve for here in terms of give them the knowledge, give them the confidence to take that next step forward.
All right, folks, just a reminder, lenders go on sale. Number 2, published rates are negotiable. Number 3, discount rates can be misleading. Number 4, comparison rates. What's the problem with them? Number 5, there is a loyalty tax that you will pay. Number 6 is the bank's customer service and retention teams, and getting a little insight into that. Now, the last point we want to talk about, Ben, is complexity is real. We just hinted at it then. These insights at beating the banks at their own game should highlight that there are many moving parts. And so now we've covered off a few, but there's stuff, right? Here's the stuff. Let's remind ourselves there's interest rate pricing, comparison rates, discount rates, who's on sale, size matters, hundreds of different market offers, retention team negotiations, overpaying via loyalty tax. Then you've got LVRs, you've got LMI. We haven't talked too much about those. Then you've got a lending strategy to save money. Then you've got to talk directly with multiple lenders. So there is actually a lot that requires you to pay close attention, and each time you review your mortgage going forward. So we get that this is there is a lot. We get you've got a life, and we get that there is a fair bit that we've covered. But if you're a serious property investor, this is the game that you're playing. We've said it, that property is a game of finance just as much as it is a game of bricks and mortar, Ben. So we've talked a bit about what mortgage brokers do, and clearly we are of the view that that's where you're going to get the best advantage. But let's talk to a couple of things that mortgage brokers can actually help you do.
Yeah, I think it's important to understand their role and the reason why they're now basically are doing 2 out of 3 loans across Australia in terms of that. There's a lot of preparation work. There's a lot of information that they need. First thing they need is obviously they'll need your financial information. They'll need to get a snapshot of that financial position because they'll obviously need to do that intelligence. And the big thing for me is that they do this day in and day out. So they have set systems. In our case, we have the Moorr platform. You put your financial information in there. We then start to go through that in terms of understand how we can qualify you for that. They're obviously also licensed professionals. So these days, mortgage broking is fully licensed. So you need to have qualifications to be able to be a licensed mortgage broker. So they're also getting professional development on an ongoing basis as they do their work. There's a lot of compliance work around credit policy, around responsible lending obligations and so forth. So be mindful of that. The other important thing that some people, we think most people know a lot about this, but they effectively, they don't charge, they don't charge for their services. They get paid for the introduction of that loan to the lender. So it's really important for you to understand that. So they'll do all this. They'll basically do the day in, day out. They're qualified at what they do. They know the current market offerings. They know what's on sale from bank to lender. And that is changing, as I said, on a day-to-day basis. So every day there's an update coming through their platforms to analyze and compare the different offerings. In terms of the really good ones, their technical skill, their subject matter knowledge. If they can sit down and riff for you credit policy, pricing policy, all of those things, the different lending options, the lending strategy and structure.
Optimal loan structure.
You've got a good one. You've got a good one if they can demonstrate their knowledge and their skill in terms of that. And obviously the bigger the group, sometimes there's also that collaborative knowledge in terms of that sharing of knowledge. And that does become an advantage. I know it certainly helps also for our buyers agents as well. When we're sharing intelligence and knowledge, they meet regularly, they're running scenarios, those types of things. So if you've got a group that's been successful or award winning, you're in pretty good shape in terms of dealing with them, because they've got great processes, great systems, great people, and great problem-solving skills. Now, in terms of what the brokers would traditionally tell you, the other thing that they do is they do the shopping for you. You heard me say it before. They shop around. I mean, they've got literally thousands of loans to choose from. There's 45 odd lenders predominantly for most brokers that are out there. So there's a real choice in the marketplace. Their job is to find the solutions and process the application for you. So they take out all of that sort of heavy work. You should be getting a proposal from them in terms of the investigations that they've made and the recommendations that they've made and why. That they all need to make sense to you, especially for refinance. We're talking about here, not for investment purchase, but just refinancing. They should be able to sort of say, here's the analysis that I've done. This is basically the true cost of the different two loans. This is roughly what the forecast savings will be, subject to change, remember, because obviously lenders can change their position in the marketplace. So
I'll put that down to match fitness, Ben. If you've got just that cadence that comes from having that match fitness versus someone who's actually taken a week off or 2 weeks off, and then they've got to, like, people, if you go through the methodically what we've talked about, you can actually do that, but for all the outsider stuff, not the insider stuff. But it's that match fitness that comes from knowing what the market offerings are, having the collaboration, knowing what the deals were that we did last week. Someone comes along, there's a slight variation, we've got access to the BDM. So I just group those things around. You said knowing the current market offerings, the technical skills, and they do the shopping around is just that general knowledge of match fitness.
And knowing that pricing also is now LVR related as well. There's going to be a period of time where they have to go off and do some research and potentially some valuations on some of those properties, because if you can tick under that sort of 70% LVR or even tick under a 60% LVR in some cases, that can make a material difference in the pricing policy that's also available to you as well. So remember, they shouldn't be able to, if they're solving it in 2 seconds with you and saying that they've got a solution, they haven't done enough homework for you. So there's sometimes it can take a little bit longer than what you might think it's going to take, because there's a lot more investigation that they need to do, and they need to wait for those valuations to come back to make a definitive position here. But that's ultimately what they should be outlining to you around, okay, here's our plan of attack. Here's what we're going to do next. Here's what we're waiting on, or here's what I'm researching in these times, and then I'll present the proposal to you.
Then the last couple of things they do, Ben, is depending on which one is your biggest lever, saving money or saving time. And for some people, that's equal or more favoured in one direction. But clearly, if you've listened to the last 45 plus minutes from us, it's all about saving money in the current environment. And then clearly, if you're time poor, which most people are, it gives you your time back. You don't have to go through and do that. You don't have to go through that calculation that you explained and across lenders and what's the options and what's the layers. So
there's still a little bit of work that we do ask, the borrower. We need those.
They've got to dish up the info.
Yeah, they've got to dish up the info. They've got to fill in the information as accurately as possible.
Yes.
So there is, it's a partnership in terms of how this plays out. But if you find yourself at that good relationship, investment savvy broker, you really want to stay with them, for the longer period of time, right? So this is about building a relationship with those customers. And then, I always refer to, as you develop that relationship, just think of me, what I used to say to my clients when I was in the field day to day, just think of me as your personal banker. And that really resonated with those people, right? Because they were like, that's right. You actually know about check accounts, you know about savings account, you know about offset accounts, you know about strategy, you know about the valuation process, you know about lenders mortgage insurance, and you know about my sort of day-to-day banking and my full. So just think of me as your personal banker. Right? And ultimately, I really don't care which lender it ultimately goes to, because I've got ultimate choice. I'm not, welded in on one lender because I've got a little logo on my business shirt that says I work for this bank. So if you're thinking about me as your personal banker, and you're building that relationship, anything to do with the banking side of your setup, that's great. Anything to do with cash flows, forecasts, and all that, that's your accountant, or, in our particular business, it's our property wealth planners, because cash flow matters about getting that next acquisition. But that's the sort of way in which you do it. So that's saving time, saving money, that building relationships. That's what you can get out of having, and we've talked about this before on the podcast, building your A team, building those professional advisors around you who are subject matter experts in their field in terms of a holistic approach. You are building a winning solution that can help you realize your plans and your goals.
Took the words right out of my mouth, Ben. We're mentoring people to accumulate their team, and having an investment savvy mortgage broker as part of their team is something that we well and truly want you to have. So here's the question: what do you do next? If you're a do-it-yourselfer, here's the message to you: get cracking, implement what we just said. Off you go and talk to the banks. You've got the knowledge, now go and act on it, right? So it's important that you do not let this information go, because if you've just listened to us, it's compelling and you should not leave that money on the table. So if you're a do-it-yourselfer, that's what you've got to go and do. If you're someone who wants it done to do with you, learn more. Go to our video series. If you go to the Property Couch YouTube channel, go and subscribe there. We're always putting new content up there. Ben's just done a series on what we've just talked about. You can go and listen, watch him. He's going to put some stuff up on the board so you can actually go and see that. So that's if you'll do it with you. And if you want it done for you, outsource, go and talk to an investment savvy mortgage broker. They are no charge to you. Make the call, go and do that. So it's important that, Ben, we've brought the information together, and whichever category that you identify with, do it yourself, do it with you, do it for you. That is the next step for you. So hopefully that's been beneficial to everyone listening today.
And Bryce, we're super passionate about the education piece. And you were saying before, we haven't talked a lot about fixed rates, other than there's lots of them coming out. So for our Moorr users, in the show notes, we'll put a link to a series that I've done recently on fixed rates. So there's a little bit of crossover in terms of some of that, but there is a lot of other information around fixed rates that we haven't covered off on here today. And so that video series is posted on the Moorr platform. So we'll get Ivis and the team to put a link in the show notes if you're interested in learning more about what do I do when my fixed loan is coming out of its expiry period. Do I refix? Do I look at other variable options? Do I shop the business overall? And so that should give you some further knowledge on fixed rates. And yes, we aspire to potentially produce a video series in relation to these variable loan ideas. And so hopefully that won't be too far away from being posted in a similar location.
Yeah, we'll put the link to the YouTube channel so people can go and see that as well. So my life hack, Ben, I said that I was going to circle back to my mindset minute. So whenever and what it was George Soros said, whenever there is a conflict between universal principle and self-interest is likely to prevail. So hopefully we've just proven over the last 40 minutes that is the case. That is the game. That is what's happening. Self-interest in terms of the person that you speak to at the bank, in terms of the management, in terms of the incentives, in terms of the targets, in terms of the shareholders' returns. They all take priority at certain levels across the board. So you need to be proactive and take necessary steps yourself. So here's my life hack today. I don't think you're going to be surprised by this, but I am conscious that we do have Empower Wealth clients who listen to the Property Couch, Ben. So I want to talk to them. If you haven't had your loan reviewed in the last 18 to 24 months, please reach out to your advisor and have them see if they can sharpen the deal on all the things that we've just talked about on any one or more levels. So that's speaking directly to our EW mortgage clients. If you're not one of our clients, go and talk to an investment savvy mortgage broker. Yes, we are one. If you want us to help, we would love to help you. Go to empowerwealth.com.au, leave your details there. But it's super important that you implement what we chatted about today. We've obviously got a sentiment in the market that is being affected by rising costs at the household level through energy, and also at the mortgage level through their interest rates as well. So it's important that we implement these things today. So my life hack is well and truly take action. Ben says at the end of every episode, take action, folks. This is really, really important.
Obviously, if I can put my Empower Wealth hat on, Bryce, I'll add to that in terms of when you do go to the website, if you're looking at it's a free, no obligation consultation. What you're actually selecting is finance and loan structure. So if you actually select what I'm interested in as finance and loan structure, that will take you into the mortgage broking review area. Probably needs to be better name than that, but it's called finance and loan structure. So that will take you to talk to one of our brokers and get you set up for that initial free review meeting. And so that should give you some idea in terms of what's available to you. And for those people who are thinking, well, but you've got offices in Melbourne and Sydney, and I live somewhere else, or I live overseas. We work all over Australia. We have clients all over Australia and around the world in terms of doing that work, and obviously really proud of the national award that we recently won last week. So that gives you some idea in terms of what we do. So sorry, that is a blatant plug. I realize it was.
Yeah. Well, it's to the point where people say, "Can we work with Bryce and Ben?" Well, generally, I've mentored all of the team who are buying, and you've mentored the team who are putting the finance together. So what you hear here is what you hear there. I think that's really important. So very good, Ben. Hey, what's making property news today?
Mate, there's a bit going on in terms of the last week around this developing story that's coming out of this narrative around greedy property investors. And so there was a gentleman who went on to a radio program and talked about having 283 properties, and that for a certain portion of the community who feel like they're doing it tough and feel like there's no way through, that was really problematic and spoke to them about the challenges that they might have in terms of finding rental accommodation or being able to afford a home. So with respect of that, I can understand that. The challenging thing for me when stories like that come up is that there are businesses, there's companies and superannuation funds who also provide rental accommodation for people. Now, we wouldn't hear a story about anyone or any company who's got 4,000 properties for rent, given that there's a current rental crisis, right? It's not a story, but it becomes a story when it's an individual. And yes, I mean, let's put it out there. Bryce and I have been talking about for over 400 episodes, you do not need 283 properties to retire financially free. But that shouldn't also discount the same reason why that person is doing what they're doing. I mean, there's judgment in this country, and it's not good for the harmony in terms of the way in which we operate as a country. So my view is, if you look through this as a lens of if that was a super fund or if that was a company providing critical rental accommodation, this would not be a story. But it becomes a story when politicians, and I'm particularly focusing in on some green politicians at the moment, who are trying to do class warfare. They are trying to articulate and speak to their base. I get it, ultimately their base is people 18 years of age to about 30, and then they leave the Greens and start voting for the other political parties, because once they start working out that, okay, I'm working really hard for my money and I want to keep as much of that money as I can to provide for my family. But in those early
allegedly, we'll just put
allegedly, they're misleading this generation of people to sort of say, it's unfair that they can have 283 and I can't have one. I mean, ultimately, whatever that person has done to achieve that, they have done through grit, hard work, determination, whatever they've done. And again, it's not a story if it's a super fund, or it's not a story if it's a company who are also doing it for profit-making purposes. So when he gets on TGB radio or whatever he did, and speaks to Ben Fordham, that the point being here is that he's also flagging that it's very difficult to actually make a margin, right? And this is what we have been talking to. The risk-adjusted returns are getting squeezed. And the worst thing that can happen for tenants right now is property investors decide it's not worth it. It's absolutely not worth it. And then the irony is we get these super funds who get all of these tax incentives and these tax breaks to build to rent properties. So we shouldn't be judging who owns the rental stock. We should be saying to ourselves, how can we create more? How can we get more rental supply into the market given these current circumstances? Now, we know there are a lot of people, Bryce, who have second or third homes for private use. So maybe the governments need to be thinking about this the other way, and they need to be flipping this on its head and say, how can I encourage you through incentive to actually make your property available for lease? We're going to have a record number of immigration coming back in after our lag period of the pandemic. So I'm just trying to be sensible about this, because any of these proposals of rent freezes and all of this other stuff does nothing to stimulate supply. And ultimately, if someone who owns a holiday home, if they don't want to let their property out, that's their prerogative. That is but if we can incentivize them to potentially provide that rental accommodation, that's going to take pressure off the rental pool. But this whole idea of attacking greedy property investors, when we know the stats, Bryce, what are the stats?
Yeah, 73% at one. What was interesting about that 283 properties too, Ben, is this person is riding off the negative gearing system. I don't know enough about this person's details, Ben, so this is pure speculation, but somebody's got 283 properties. I can promise you they're probably pretty close to, if not, they'd be significantly positive cash flow. So they'd be actually contributing to the tax purse, not negative gearing.
You couldn't, Bryce, you couldn't get the borrowers.
Not stimulating supply is the critical point here. And importantly, Ben Fordham, who was on that in that article, declared that he was a property investor, but also said, look, I don't think it's reasonable that people have 283, which you and I both agree with, that people should have a super. And now that the super rate's going up, probably only 2 properties. We've been saying for the last 400 properties, probably 3, but you can probably get away with it with 2 now. So we're certainly not suggesting that we're not advocates for people getting 283 properties. It would be a nightmare to manage them for a start. So, but I think to your point around why is this person being singled out when there's other entities that are actually doing something similar? And I get we have an emotional topic here. It is a roof over our head. It's an essential need. It's shelter. It's why investing is actually in property is good, because it's the only investment asset in the world that's not dominated by investors. So we can actually look for the inefficiencies, and if you're smart and you know which ones to buy, you can actually use that to get an outperform result. But I think
it's counterproductive of painting property investors as villains, Bryce. You're putting a wedge between the marketplace, and that is unhelpful in terms of harmonious open market activity. And I'm calling out politicians who try and do that, because it's for their own political gain and their own political advantage, of which they're speaking to their base. But we're not villains. We're just people trying to do the right thing in terms of providing for our family and taking ourselves out of the government purse come retirement. I'm going to be positive government taxpayer for the rest of my life. I will never be taking a pension. I will never be taking any additional services that aren't available to me, because I'll be earning that passive income, which everyone well knows. So this to me is just annoying in the sense that they're trying to put a wedge between us, and they're trying to portray us as the villains, when ultimately what they should be thinking about is, oh my God, if we didn't have these private rental providers across this country, could you imagine the chaos? Could you imagine the problems that this country would have? We should be getting silver and gold medals for basically providing this accommodation, compared to the fact that the governments have taken billions of dollars out of the social and affordable housing model. So from my point of view, it's like, please, with respect, treat us with the same respect as you would anyone else who is going about their business. And if someone has been successful to be able to do 283, when you know that over the course of the next decade or two, superannuation funds will have thousands, if not tens and thousands of these types of properties with tax incentives that mum and dad investors don't get, which is coming out of our pockets, but ultimately it's coming out of all taxpayers' pockets to be able to do that. I just think it's a raw deal, and I want it to stop. We are not greedy. We are just trying to do the best that we can for our families in an open market and provide that critical rental accommodation for those people who are moving around.
There you go, folks. Do you agree with what Ben just said? Let us know on socials. We'd love to hear from you. But we've covered a big show today, Ben. We are effectively saying to you folks, make sure that you put more money in your back pocket than you are in the banks. And we've given you some steps and some processes for you to be able to do that. So, mate, as always, it's good to dive into your subject matter expertise as the mortgage broker that was quoted in the second last election campaign. So it's always good to dust the rust off on that too, mate. But thanks for your input, putting all that structure together. But mate, until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Well said. See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1, because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. But folks, I want to encourage you again to go to thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.